we post trade recommendations, technical reports to institutions, direct clients, and brokers. We cover 25 odd products. We're ever expanding. Today we're due to talk about FX. FX is my speciality, if you like. Been producing some webinars for FX Street probably for about 10 years now. We did have a break while we redeveloped our current website. So what we're going to look at, we're going to look at some what I call vanilla charts. Okay, so they're charts with no real indicators on them. You know, we've got no moving averages. We haven't got any oscillators. So they're pretty basic candlestick chart formations. And then basically what we look to do is we then look to break down price action, talk about medium-term forecasts, using correlation, using time frame breakdowns, using price action. And we're also, I think today we're also just going to throw in one oscillator. So we don't just like to constantly sort of just predict the markets. What we're also looking to do as well is also to teach and inform people of our methods of analysis. We have got a grey box system that we have developed over the last 5 to 6 years. This highlights support and resistance in different time frames. So a lot of the time when we're doing these presentations, you will hear us saying we stalled at our bespoke support level, or we've bounced off our bespoke support or resistance. Okay, as it's taken us so long to develop our system, I won't be divulging exactly how we make these support and resistance levels. They're not set in stone. They do move. Okay, so with say if price action starts to move to the downside, obviously our support levels more often than not will start to drift lower as well. So they are quite unique, we believe. So the first thing we're going to talk about is the dollar. I'm just going to check on my other screen just to make sure that the right chart's on. And please do interact as much as possible. We'd like to know that people not only listening, but you know, the more questions you ask, the more we know that you're sort of getting the gist of what we're trying to say. So first of all, we're going to look at the dollar index. Dollar index is the most important chart, as far as I'm concerned, that you can look at. It's correlated to 6 of the FX majors. It's also correlated to oil, gold, etc. You also get a run to the dollar, obviously, well, a lot of the time when there's risk aversion. So if we can get the dollar right, or the dollar basis right, then it sets our game for the day, if you like. And one of the things that we did this morning off the back of the dollar index was, instead of just opening or selling some of the dollar-based majors at the open, because of our bias in the dollar, we actually waited for pullbacks. So it does work. It is very important. And by using the dollar index and the bias in dollar index, and then our bespoke support and resistance levels, we can get some decent entry and exits. So we're going to talk about the dollar. We've got the monthly chart in front of us. Okay, not necessarily at a great technical level where we've stalled. We've obviously had this very large downward move from 2001 to 2008, and then a choppy price action back up. This was going to be our prime target level. This is obviously a Fibonacci confluence area, so it's 61.8% of the decline, which comes in at 102.10, and it's also 161.8% extension of this first wave. comes in at 102.08. So it was a prime target area. Now what's happened is we have stalled around a previous high, and we have highlighted in shorter time frames the bias to move lower before we probably get a reaction back up. Okay, this is not a confirmed double top. A lot of people will be looking at this saying, well, it's the same level as it stalled around about March 2015. We've had a reaction lower, but we haven't had a firm reversal pattern. Okay, by reversal patterns, what we're looking for is morning star, evening star formations. We're looking for outside bars. And by an outside bar, again, I'll explain this as we do every time we do a webinar. An outside bar is not an engulfing candle. Okay, an engulfing candle, the body has to take over the body of the previous candle. In an outside bar, we're looking for a whole candle to engulf and take over the whole range of the previous candle. So we can see here, last month, we did move lower, spike lower. Let's just zoom in a bit, so because I know the charts aren't fantastic. And then we've had a tendency to move to the upside. So you can see around this level, these dips continued to be bought into. Okay. Plus, we keep on. We're 90% technical, 10% fundamental. Okay. There was good figures again out of the US on Friday. Some analysts are even turning around and say, well, you know, it's maybe paved the way for another March hike. I don't know if that's going to be true or not, but fundamentally, you've still got that bias for higher dollars at the moment. Okay, in this long-term view. Remember, we're looking at the monthly chart here. We're not looking at a daily chart. We're not looking at a 4-hour chart. This is the monthly chart. And what you've always got to remember is that you're breaking down time frames. Okay, if you want to purely trade the trend, then that's what you have to do. You have to say, well, the monthly is bullish, the weekly is bullish, the daily is bullish, the 4 hours bullish, the hourly is bullish, I'm buying it. You could potentially not trade for 2 to 3 weeks on the back of that bias, if you like, or that form of trading. There are many different forms of trading. So what we're looking for an overall bias, a medium-term or long-term bias. We're then looking for shorter-term bias. So we know if we're counter-trending, we know whether or not we're trading with the longer-term trend. And at the moment, this longer-term trend off the monthly chart is still slightly bullish. Just got this question. Can you please repeat how the differentiate the outside bar from a bearish engulfing candle? Yeah, sure. Let's get an example. That's the best bet. Okay. There will be a few here. Okay, this is the best example probably on this chart. This candle here, let's get rid of we'll take the fibs off. Okay, this candle here is a bearish outside candle. So this candle range is completely inside this candle. Okay, so but in other words, what's happened here is the market has been bullish. In fact, that's an outside candle, even though it's not, even though the body hasn't taken over the last body, it's still a bullish outside candle. So basically what's happened here, we've moved to the upside, we've dipped, and then we've kept on moving. And what's happened is the market has made a higher high, but then the bias or the sentiment, which we like to call it, has completely changed, and it's made a lower low. So in other words, the sentiment has changed from buying dips to selling the rally. Okay, so you've taken out that candle. Now, what's different from that to a bullish engulfing candle or bearish engulfing candle is that in a bearish engulfing candle, all you're looking for is the actual body. So here, this is a bearish engulfing candle. Here, the body engulfs the previous body, but the range doesn't. Okay, just so happened this one worked to the downside, but so that's the difference. An outside bar is exactly what it says. It's completely outside the range of the previous bar. An engulfing candle only takes the body into consideration, not the spikes. Okay, So just the body. So this is a bearish outside, sorry, this is a bearish engulfing. Where's she gone? This one's a bearish outside bar. Okay, hope that explains that one. And they're more powerful. I'd say they're more powerful than dojis, they're more powerful than evening star formations, they're more powerful than morning star formations, because what they're telling you is that there is a change in sentiment. Okay, that's what we want. We want a change in sentiment. So here, we'll just break it down to the weekly. Okay, we did have a weekly engulfing candle, okay, and that's kept the shorter term bias to the downside. Now it's not until we break down to a daily chart, okay, and this is obviously the previous high up here, okay, and then obviously this was the strong sell-off in the dollar after the ECB announced that they probably weren't going to be as aggressive with QE, etc., which the market was expecting. So we just want to note swing highs and swing lows. So this area here, which is around about 96.90, was an area that supported price action, okay, going back to March, April time. We then saw a few spikes here. So we know that this is what we call a confluence area. Okay, so it's an area where, or pivotal area, where price action likes to move around, if you like. Okay, so it acts as support, and then when we break it, it acts as resistance. Okay, so basically now it's resistance, it's now support. Okay, because it gets broken, then becomes support. So the difference is that an engulfing engulfs the body, while the outside engulfs the shadow as well. That's correct. Yes, Fabian. So now we have got an immediate bias lower. Okay, so we've got this strong move to the downside. Okay, then a choppy free wave correction. What you want to be looking for in most moves is, if they're impulsive, you're more than welcome. If they're impulsive or corrective, okay, impulsive moves have a tendency to go quickly. You can't. It's difficult unless you break down into shorter time frames to actually note the wave counts, etc. So the impulsive moves are aggressive and quick. The corrective moves are choppy and normally in free waves. Okay, so what we're looking for here, this was a channel that was corrective. Again, very choppy price action. You can see it in free waves, 1, 2, 3, 1, 2, 3, etc., etc., etc. It then breaks out to the upside. This trend line, because trend lines don't just have to be horizontal, they can be at an angle. So this trend line is now support. So we've got a trend line break. This level is now support. So what happens normally, or quite often in corrective patterns, is that we'll get free waves, and free waves. And the we call these waves ABCD formations, okay? And sometimes the AB equals the CD. Not always, as with technical analysis. It's always, what we're looking for is something that happens more often than not, okay? And basically, if you find enough things or actions that happen more often than not, you can set a trading system around it. All you need is 6 winners out of 10. As long as your risk reward is correct. In other words, as long as you're always looking for at least 1-to-1 risk reward, then all you need is 6 out of 10, and you just keep on pressing the button. Okay, so the basis behind technical analysis is to try and find things that force the market in one direction or the other, or have a tendency to repeat themselves. Wedge formations, they have a tendency to break to the downside, and ascending wedge formation. Flags have a tendency to break up or higher or lower depending on where the flag pole is. So all these things have a bias. Most of them are between 6 to 7 out of 10. Wedges are normally 7 out of 10. Flags are normally about 6 out of 10. Head and shoulders, if you get a break, they're normally quite good. They're about 6.5 out of 10. But you've got to wait for the break. You shouldn't jump into the right shoulder. So digressing a little bit, but all these different factors, formations or things that happen in technical analysis and chart formations, that more often than not have a tendency to have a follow through. Okay, and that's what we want. We want that follow through action. Okay, so what I'm doing here is I'm just putting an ABCD formation on. So what we've done, we've had this strong move to the downside, again in 3 waves. We've then had a corrective move higher, again in 3 waves. Now, if this is to be a trend reversal, in other words, dollar bearish, then this has to be impulsive, because this will be the 3rd wave. So we'd say 1, 2, an impulsive move to the downside. So this next move is extremely important. An ABCD formation also lines up with the 127.2% Fibonacci. And that is quite important, because a lot of symmetrical patterns, and again, I'm digressing a little bit here, but a lot of symmetrical patterns use the 127.2% extension. Normally it has to line up with a reversal. So again, you're looking for sort of confluence areas. And here we've got the 61.8%. So an ABCD and a Fibonacci confluence area is around 96.37. So we've got to be careful around that level. What we want to see, if we're looking for bearish continuation in this dollar index, is this move to be very quick. Okay, very quick, very aggressive. Now, this is also where we not flip the table or what. We want reasons. Okay, so even though we're, like I said before, 90% technical, we've got to look at the fundamental side. And is there any real economic releases that are going to make us aggressively sell the dollar this week? Because this is what we're looking at. You know, this is a daily chart, so we've got to get down here pretty quickly. So we look at the calendar. We've got Bank of Japan tomorrow. I'm just looking at the FX Street calendar. And we're looking for 3 tier figures. Okay, so we've got non-monetary policy ECB meeting Wednesday. Bank of Governor Carney's speech on Wednesday. We've got Australian employment change, and then we've got B of E and ECB monetary policy meeting accounts on Thursday. So there is potential out of the economic releases this week to push the market aggressively. But this is our key, okay, 96.37. If we stop and reverse there, then the dollar bias flips back to the upside. But we need to see a reversal candle around here. Now, you might be saying, well, how could we have traded this bit here? So that, again, you're breaking down to another time frame. And we want to be looking at price action. So we're using Fibonacci retracement levels. We're looking at trend lines. As we break down through these time frames, let's get this to work. Okay. Okay. So, strangely enough, these are Saxo charts. We use Saxo charts for sort of our vanilla charts, if you like, our plain charts, and then we also use Aspen graphics, which we put overlay our system onto, and also all of our sort of triggers. Sometimes what has a tendency to happen is that there will be a difference in candle formations of different time frames, and this candle here is actually a bearish engulfing, or it's a doji candle on my charts. So basically what we've seen here again is this erratic move to the upside, okay, and then an engulfing bearish candle down to trend line support, and then we've had this bounce up, and this bounce up, there is no indication here apart from this doji, which to be honest aren't the best signals. they're price rejection, but for me they're not price reversal. I mean, we have got bespoke support at 98.13 and it made a low of 98.14, so we didn't sell into it. And like I was saying this morning, we looked to sell dollar rallies, and that's basically what's happened. The dollar's moved to the upside, and we have resistance at 98.76, and it's made a what high? 98.78 high. So we've sold into this rally. So our bias now, this can be seen as a channel, this could be seen as a wedge formation. Rallies are being sold into. Got an outside bar out off the high, but a small bounce from the channel base, but the bias is now to the downside. Okay, and remember where we said that confluence area was, or that area, that ABCD formation, etc. And then we just want to test fibs, if you like, just to see where they're looking to, because we've got to remember we've got to have target levels, and a lot of the time we want things to line up. Okay, so we want to quite often there'll be areas where a Fibonacci level will line up with a previous low, a previous high, where it will line up with an ABCD formation target, where it will line up with a reverse trend line, etc. So we want to look to those levels. And here, okay, we've got a 61.8% extension at 97.31. If we move across, we can clearly see that that area was pivotal before. It was support. It's going to be support now. Then probably a small bounce, and then a move to the downside. So the bias, the immediate bias in the dollar is bearish. The long-term bias, who knows yet? Okay, we've got to look at that medium-term level. So here we've got 95.80, and again, does it line up? Well, not a million miles off. We're 96.37, and I reckon this reverse trend line is probably going to be 95.80. Yeah, the reverse trend line, which is now support. Remember, we said it was resistance, now support. That reverse trend line is at 95.86. So this area, so we'll just get rid of the tracker on there. Just get rid of all these fibs. So this week, this is our target area. Okay, 96.46-ish, 95.80. So when we reflect that back onto the dollar majors, basically what we want to be looking at is we want to be looking at selling into dollar gains. So in other words, buying into euro dollar dips, selling into dollar Swiss rallies, selling into dollar yen rallies. It's not as easy as that. If it was easy as that, then all we'd do is analyze the dollar index and be done with everything else. Obviously that doesn't happen. You know, we've got cross currencies, euro Aussie, etc., euro Swiss. So something or a currency pair will dominate the dollar more than another currency pair. So we're using correlation. It's like this morning, you know, euro sterling, doji overnight, probably a bias to break to the downside. So even though the dollar index, we were expecting a small rally higher to sell into, it probably wasn't going to move lower in cable because of that euro sterling bias. You see, so you have to put these different correlations together and formulate which currency pairs have the stronger bias to move in the direction that you're looking for them to move in. What are the fundamental reasons why you are selling rallies on the dollar? Or is it based on technicals? It's just based on technicals. Like I said, we're 90% technical, 10% fundamental. We like to listen to the news. We like to listen to the squawk. We like to, in the background, know what's going on with regards to economic releases. But really, we believe that all prices reflected in the market, which is sort of a technical analyst mantra, if you like. So at the moment, the charts tell us that we should be weaker in dollar, and we'll, you know, and it's not just what this chart tells us. We have to reflect it onto other charts. If it doesn't add up on the other charts, then maybe the correlation has gone slightly out of that currency pair, or we've got the dollar bias wrong, which obviously happens sometimes. So any questions about the dollar before we go and talk about euro dollar, and then we'll break down and talk about some currency pairs. An interesting one today, which is going to digress a little bit, I don't know if I've got it on here, is sterling yen. Now a lot of retail traders love sterling yen, big moves, big numbers, etc., etc., etc. But one thing that, again, I'm digressing a little bit here, but one thing that dollar yen showed today was a rule of 9, and I don't know if you guys have ever heard about the rule of 9. So the rule of 9 dictates that if you get 9 negative or 9 positive candles in any time frame in succession, then the 10th candle should be at least a corrective move in the other direction. And here we've actually got 9 candles to the downside, and then we've seen this upward move in sterling yen today. It's probably going to form an insider army candle, which basically is the whole price action stays inside the previous bearish candle. That is completely opposite to a outside candle. An outside candle shows us a change in sentiment, which we said. An inside candle or a Harami candle is indecision. The market hasn't broken in either direction, it's stayed within the range. So the way to trade an inside candle is that you have to look for a clear breakout and close of the range. So indecision today, but rule of 9 sort of dictated a mild correction. And again, that gave us a small bias on sterling dollar this morning. So again, talking about the correlation between different currency pairs, we were buying dips in euro dollar this morning, but we were buying a break in cable higher because cable had more of a bias to break quicker than euro dollar. So euro dollar, again, the big picture, aggressive move to the upside since 2000 to 2008, mirroring that dollar move, okay. And then this is a decent outside buy here, decent outside buy here. So you can see how powerful these candles are, and even an outside buy here. The reason that we break down through time frames is because the higher the time frame, the more powerful the candle, because then it should rule or dictate the overall trend of the smaller time frames. There's actually a name for these candles, not just an outside bar, but on a monthly chart, and they're called acute monthly reversal candles, and they shouldn't be ignored, okay, because a lot of the time they do dictate a change of trend. And in fact, there's a bullish outside candle there. So you've got a bullish outside, bearish outside. You've got a morning star formation, which again is an acute monthly reversal formation, a bearish outside candle, an insider Rami with a break to the upside. This is a bearish outside candle, but it didn't produce much returns. And then again, a bearish outside candle. What do we have down here? We don't have any of those. We don't have those acute monthly reversal formations, bullish formations. And this confluence area, 150% extension level is not really a Fibonacci level. Not one that really counts, if you like. It doesn't make symmetrical patterns. It doesn't fall into the equation of Fibonacci with the recurring number sequence. So it's debatable whether or not it should be there at all, really. Breaking down. However, technical analyst's favorite word. However, we have seen a bullish engulfing candle close to the previous low. It is not a double bottom. It has to break here to be a double bottom formation, and then the bias becomes strongly bullish, because then you're looking for this level, you know, the 140s. But at the moment, it's not, okay. And in fact, there is trendline resistance up here. So if we just put the hour candle up, so around about 112.70, we're going to sort of come into some strong resistance. And if you look back again, it was sort of an area of previous price action or support and resistance being pivotal. It's also, let's get rid of that, it's going to be the Marubozu level from this candle. Okay, these spikes make it resistance. Okay, so it's quite 112.10, 112.70 is an area that we need to be aware of, put it that way. Going back onto the daily chart, okay, this was an expanding wedge formation, had a bias to break to the downside. Where is the target level for any wedge formation? Well, the target level is the start of the wedge, so it didn't quite get there, but it was near as damn it, really. Expanding wedges are the hardest chart formation to trade, because unlike an ascending wedge formation, that's an ascending wedge formation. So basically what happens in an ascending wedge formation, we move up in it and we get tighter and tighter and tighter and tighter, like a spring, until it breaks to the downside and then it aggressively moves to the target level, which is the start of the wedge. Okay, so the great thing about an ascending wedge formation is when it breaks to the downside, we can either sell the retest, which it does quite a lot, it comes up and retests the breakout level, or we sell at market and we put our stop back inside the wedge formation. So the risk reward is normally about anywhere from between sort of 5 to maybe 8 to 1. So a great formation to trade. Trouble with an expanding wedge formation is that the price action gets bigger and bigger and bigger and bigger, and you never know where it's going to break to the downside, because it isn't a coiled spring. It's an expanding spring, if you like. So what happens a lot of the time, it breaks out, then moves up to retest, and then moves down. But again, where do you put your stop? The stop level compared to the reward level is much worse than an ascending wedge formation. And more often than not, the target level isn't as far away as it would be if you had an ascending wedge formation. So what's happened? We've had a more short-term time frames. We've had a decent move to the upside. Okay, then corrective free wave pattern lower, just breaking it down into shorter time frames. Just looking what our trigger level was this morning. Let's get my euro dollar charts up. 108.75. We bought it. Is that right? Look on our dashboard. 108.75. So again, impulse move, free wave corrective manner. Look at these inside waves. 1, 2, 3, 1, 2, 3, 1, 2, 3. Okay, so it's corrective. So move lower is corrective. We put the fib on. Where's the fib? 61.8%. Okay. We put a channel on. Again, you know, channel formations, you want to be buying near the low of the channel. You don't really want to be buying the breakout. I mean, false breakout this morning moved to the downside. But again, so you're looking for things to line up. So you're looking for a bias in the dollar. But then you're not just looking for a bias in the dollar. You're then looking to transfer that bias onto your dollar-based currencies to try and get some decent confluence areas, support and resistance areas where you've got not just one reason to buy, but numerous reasons to buy. So here we've got a 61.8% pullback level, okay, of this move. We've got trend line support. And again, on my charts, this candle here on the 4-hour chart is a bullish outside candle, okay? And we get that move to the upside. Now, there's nothing here that suggests that this rally is coming to an end. Okay, there's a doji style candle posted on the 6-hour chart, and it did close. The next candle did close down near the low, but it's not a reversal pattern as far as we can see, and still using that bias in the dollar, we prefer to buy into the dollar. So we've bought the dollar at 108.75 this morning. It really only has to get about another 10 ticks up from current levels, and we'll be looking to pull stop into open, because the signals aren't fantastic here. You know, this is where we want to be in. We're sort of buying mid-range, if you like, but we really need to get a decent breakout to confirm that this rally is still on, and we're not going to have a larger correction, maybe down towards sort of 108 the figure before the next rally. So the bias in euro dollar is bullish. How long for? Well, again, we need to break down time frames. Sorry, hold on 1 second. So again, it's not a case of not wanting to be in this trend or for looking for places to get out of a rally. It's more of areas that we need to be aware of. Okay, so here we've got 112.45, and then we move back. Okay, what's this level here that we talked about? This is the reverse trend line, yeah, that we talked about. If we put our crossover tool on, where is it? It's 112.55. That current, so it might move along a little bit, maybe 112.60. So that looks like a good target area because it's an ABCD formation. It's probably a fib extension. You know, 112.03. And again, we're just looking for various reasons why that area is prime. So, you know, 112.10, 112.40 is the next target area. If it breaks there, then obviously we want to see a move up to here, 113.90. Then a move back towards what was support, or sorry, what was resistance, then becomes support. So you're leaving these on the longer time frame charts as well. You're leaving these trend lines on. You're leaving these Fibonacci extension and retracement levels on, because you want to see how price action reacts around these levels. And again, you want reversal candles, you want outside bars, okay, you want dojis, you want another outside bar, you want inside aramis with breaks on them. You want price action to dictate where you're going to go, not you guessing where you're going to, you know, where you're going to end up, if you like. Given your bearish bias on the dollar and the appreciation on euro after China crash, what's your opinion on why euro dollar is falling this morning? It's not falling this morning. It's fallen overnight, but it's the dip has been bought into. As we said, we look to buy into dips. The dollar bias for me is still to the downside. So at the moment, we're still buying in dips. I don't think there's any real reason to change that dollar bias yet. And I don't call, mind you, you can say I don't call a 100-point move lower in the euro dollar, you know, a fall. It's still making higher highs and higher lows. It hasn't reversed the trend. It hasn't given a reversal formation. Dips have still been bought into. I could see no reason why I would particularly want to sell euro dollar from current levels. I prefer to buy it, and that's exactly what we have done. So that's euro dollar. Cable. It's a bit of a different story. And again, we're just breaking down through time frames. This is the monthly chart. Channel formation. We've broken out of the channel formation to the downside. We have got a previous area, again, pivotal area, around 147, 145.70, with dips under that level being bought into, and then obviously technical level here. So there is support here in cable. And again, we've just used that correlation again this morning. Fib levels. I think that there's always issues with fibs, because what you're looking for, not just the sort of fib extensions and retracement levels, and we've got the symmetrical bats and butterfly formations, etc., etc. But we also want to see price action. We lay them on top of all the charts because, as we were saying before, we're looking for things to happen more often than not. So more often than not, you will get a reaction in a chart around the 161.8% extension level, sometimes around the 127.2% extension level, especially if it lines up with a previous low. Sometimes it doesn't reach 261.8%. So what our sort of technical analysis, or what we do at PIA, is we still use these levels, but we also use price action and our support and resistance levels to dominate where we believe price is going to go, not just purely pumping Fibonacci, well, it's going to move to the 261.8%. That's the 5-way extension, because here, as you can clearly see, if this is wave 1 and this is wave 2, wave 3 is supposed to be impulsive. It should have got down to wave 3 very quickly, where it hasn't. This has been the impulsive move, actually, which has been over the sort of the December markets. So we've got reasons to believe that we can at least see a bounce higher from these current levels, because 145, as we said, 70 odd levels under there have attracted buyers in the past. We've got the dollar bias that still highlights the dollar going lower, so hopefully sterling dollar going higher. Then break it down into time frames. Again, 4 hours not showing a great deal. Let's just get my main charts up on the other screen. Long chart. Okay, we also use something that's called DMARC. Okay, which DMARC highlights exhaustion and correction counts. Okay, this guy basically, going back a long time, used to analyze charts, and he used to analyze them on paper. So literally before we had computer programs that did all the chart formations for us, he would actually note everything down, and what he noted was that you get a certain amount of moves in one direction before you get corrections or reversals. You could do a whole day with one webinar on DMARC, because it is a fantastic tool. But I'm digressing a little bit. But what DMARC has done today is posted a 9 count on the daily chart. So we've got a 9 count, or a rule of 9, I should say, which is different from a DMARC 9 count. So we've got a rule of 9 on sterling yen, which gives us a correlated bias to buy cable. We've got a 9 count on the daily chart from DMARC. And DMARC basically says that you get to 9 and you should at least, well, you will correct within the next 4 candles. On my charts, and not on these Saxo charts, which are a little bit disappointing, we've got a and in fact that spiked lower. They don't even have on my chart. I've got a 145 low. We've got a bullish outside candle. So I think basically what we're looking to do here, well, we've bought it already this morning, but we're looking for a move up to this sort of area. And where does our resistance come in? 146.27. Our next resistance is, which is about here. I think we'll get a move up towards this sort of level, and then we won't outstay our welcome, because at the moment what did we say before about higher highs and higher lows? Higher highs and higher lows means we're in an uptrend. Lower lows and lower highs means we're in a downtrend. At the moment, we really have lower lows and lower highs. We could say that this is a break of trend, but it's only a short-term break of trend. So we've got resistance up towards this level. And what we prefer to do is just buy it up towards that level and then look for a solid reversal candle formation. Because you've got to remember what I was saying is that we're looking at really outside bars, but we really want outside bars in higher time frames. And at the moment, we haven't really got outside bars in higher time frames. So what we're either looking for today would be a close above 146.50, which is up here, which would in turn post a bullish outside bar on the daily chart. That would also give us a demark. So we get a demark correction count, a bullish outside bar on the daily chart. If we look to the 6-hour chart, it would be a morning star formation. The 4-hour chart would be an outside engulfing pattern. You know, we're looking for reasons, okay? And then we'd say, okay, what do we want to do? Do we want to buy at market, or was there a lot of resistance around that level, or a lot of price action around that level? And are we likely to correct lower and be able to get a better entry level? So if we move up towards this area and stall, then we're more likely, or we're better off with regards to risk reward, to buy dips back around this level 145.50 in a head and shoulders. So this would be our left shoulder, this would be our head. I'm discounting that candle there. And then this would be our neckline, and then again 145.50 right shoulder, and then a break higher. So at the moment we've got a mild bias higher using correlation, using the counts, using the outside price action in shorter time frames. But what we really want to see is we want to see a solid reversal formation, a reverse head and shoulders pattern, or we want to see an outside bar on the daily chart to turn this sentiment back to the upside. Because at the moment it's only the short-term bias, and this again we're talking about breaking through time frames. Okay, it's only the short-term bias that gives us a bullish aspect, if you like, on sterling dollar at the moment. Any questions? No. We've got time for one more. I suppose dollar yen is quite important at the moment. It was always important, but so quickly just talk about what we're seeing there. Now this, again, is the monthly chart. We've got an outside month, but it wasn't posted at the high. So it's more of a continuation candle than a reversal candle. Okay, but this rally has been sold into. We have moved down. Now we've actually been talking about this for quite some time in our reports, and I still think this is the head and shoulders. Slightly disjointed, deformed, if you like, right shoulder, but still I think this is left shoulder, head, right shoulder, and neckline. So we're very close to the neckline at the moment. Normally what will happen is we'll get a small bounce off and then a move lower. So what we really want to be looking for is either selling a break or selling an area where it will give us decent risk reward to move to the downside. So if we look to this level, which is 118.66, we look back across price action. So I'm just going to put a line on there. Okay, so we look back across price action. Dips bought underneath, it acted as resistance, and then acted as support, You've got it, it's broken now, so it's now resistance again. It's not just that, but the weekly chart, we're going to have a Marabuzzo level around that area. A Marabuzzo level is the open and the close added together divided by 2. So it's the midpoint of the whole candle. And basically all we do is go open 120.05 plus close 117.25 equals divided by 2. Okay, 118.65. So that is the prime area to get short in dollar yen this week for a break back down to the downside. Shorter time frames, and again, talking about that ABCD formation, okay, it was virtually pit perfect. And we had a decent outside bar again, so a change in sentiment. Sentiment was bullish, outside bar, and then we moved all the way to the downside. What haven't we got down here? We haven't got a bullish outside bar. Okay, so it hasn't highlighted that we should be looking for higher levels now. It's still saying, well, this is probably just a mild correction. It's past the 161.8% extension. It's probably a mild correction, 118.65 being prime. And again, 4-hour chart. Any particular reason you'd want to sell it? Oh, sorry, want to buy it? No. Okay, gets up towards this level again. This is 118.50. It might form a head and shoulders, but I doubt it very much. Okay, it's an area 118.50, 118.65. It's an area where we should be looking to short this currency pair, not buy it. Okay, that's my time up. Any questions at all before we call it a day? No. Okay, well, thanks for listening. Enjoyed the seminar, webinar, I should say. Hope to see you again in 2 weeks. My colleague Steve O'Hare will be here next week talking about indices, commodities. If you want to have a look at our website, it's PIA First, PIA/first.co.uk. You can sign up there for a daily free call. You send out an email with a daily free call on a daily basis. Okay, thanks very much, guys. Good luck with your trading, and I'll see you again in a couple of weeks. Thank you. Bye.